Coming up today, Apple's latest iPhone. Stocks start the week on a positive note. Palantir surges, the latest from Janet Yellen, and where to invest instead. Where home prices are falling the fastest. Tropical storm Francine approaches. Cannabis stocks rip up, and the changing world of politics. It's going to be another big week, guys. Let's have a good one. And welcome back, everybody, to certainly a better start to this week than what we had last week. Shortened trading week. We started off on Tuesday. Sharp dive down, just like we finished on Friday. In fact, it was the worst week in over a year. However, today we've bounced a little bit and put in an inside candle. And just looking at market color, still got elevated volatility. Gold's green across the board. A little bit of a bounce in discretionary and industrials. However, it's still the defensive trade that's leading the show. REITs, staples, and utilities still green across the board, with the weakest sectors being energy by far. Bitcoin still under pressure, as is the dollar, and growth and momentum stocks. And stick with me today because I've got a few interesting stories for you, including Palantir that surged 14% today. We've also had a nice move up in the cannabis sector ETF, up over 11%. I'll talk a bit more about that later on. However, the leading story today, one of the biggest ones this week, is Apple unveiling its latest iPhone, in which it's said to be the first version of the next generation of Apple Intelligence. Apple finally making its foray into AI, along with the latest of all their other products as well. Stock market, a little muted reaction on their event day, and just going down to a 5-minute chart, they actually sold off in the morning. Found a little bit of support before lunch. It was a bit of a roller coaster ride. Traded up, back down mid-afternoon, and then back up into the close, pretty much finishing flat on the day. But the price action appearing that Wall Street's a little undecided at this point what to make of their latest iPhone 16 and its likely impact on their business going forward. Okay, so just looking at the press release on their website that just came out today. Looking at the iPhone 16, does seem to be a bit of a step up from their previous upgrades, in which they'd been criticized for not doing a whole lot, just making a slightly better camera, slightly better screen, not real much difference. However, this one does integrate more AI features, Apple Intelligence, and it's kind of the start of the era of having a personalized AI agent. That's where it's all going next. Even ChatGPT is starting to learn us and remember something we've told it a month or two ago, and Apple having the huge advantage of having the #1 device in the world. They're obviously in the best position to kind of capitalize on a trend of having a personal AI agent. They also came out with a larger display size, better camera, and a huge leap in battery life, with them saying they've built this model from the ground up for Apple Intelligence. You can easily summarize and rewrite emails. You can do other things like search for images in your phone that you may have taken a few years ago. Apparently there's a whole new range of emojis as well. Not sure how much of a big deal that is. An incredibly light and durable design with a larger display, introducing camera control and a much better battery. And also a 6-core GPU with much improved graphics and gaming. So I don't want to take away from it too much. Doesn't look too bad to me. I guess the Apple Intelligence is something new with this upgrade. Not exactly mind-blowing at this stage. Looks like Wall Street agrees, just looking at the price action in Apple shares today. Although we could still get a bump up in the rest of the week going into the weekend. We saw that last time. Bit of a muted initial response, then the market really warmed up to it. The iPhone 16 is going to start selling at $799 US, 16 Plus $899, with the Pro $999 and Pro Max $1,200. Also came out with the new Apple Watch Series 10. New design, bigger display, that starts at $399, and AirPods Pro 2, baseline model $129. So far, surveys show consumers not overly interested in AI-based smartphones. However, that could be because they don't really know what it is just yet. I remember Steve Jobs saying the old mantra in business was always give customers what you want, and he famously said, customers don't know what they want until you give it to them. Make something awesome and then they'll want it. So that could be the case with Apple AI. And like I said, I think the huge potential is for them to dominate with having a personal AI agent. And then they may be able to do some paid subscriptions or serve some ads around that as well. Or partnerships with who they recommend, to book your travel, do your shopping. And if you can just speak in a voice to your phone, to your own agent and just order stuff, I'd imagine that has a lot of value attached to it. And that's probably why Apple's been doing so well this last couple of months, ever since the market got wind of the new iPhone 16 Apple Intelligence around the corner. It's been holding up pretty well, which is actually in stark difference to other mega cap tech stocks like Microsoft, trading pretty heavy of late, actually consolidating for over half a year now. It's been going sideways since late January. And there's a look at leading consumer discretionary stock Amazon, also going nowhere for half a year, trading a bit heavy here. Same with Alphabet, actually sliding lower. Holding up a bit better, Meta, still consolidating for 6 months, not too far off highs though. And Tesla, really volatile year. Started off really weak, bounced up, but it too has also been pulling back. And the big one, Nvidia, trying to find support in the low 100s here. Bit of a key level we're watching watching, along with semis as a whole, also trading heavy. So we'll be keeping an eye on Apple this week. The market could very well get excited with it, and we could be back to new highs, and that would obviously be a positive for the Nasdaq, especially if Nvidia and a few others can bounce back with it as well. Doing the best today was Palantir. After we got the announcement after close on Friday, S&P Global adding Palantir into the S&P 500, something investors had been looking for months. Got the confirmation along with Dell, and that basically mandates huge amounts of investor funds around the world that they have to invest in these stocks. And that's why we got Palantir trading up 14% today. We also got the good news. One of their earliest customers, BP, have expanded their partnership with Palantir, extending their contract by 5 years. And actually, the BP CEO just came out and said Palantir has pretty much transformed their business. Really strong indication to the market of the value that Palantir products provide, not only to commercial but government as well, all around the world, helping them to better understand their data and make intelligent data-based decisions from their analytics. Stock breaking up to a new 52-week high, having an absolutely fantastic year, currently trading at 34.60. Not doing as well though was Dell, which also got added to the S&P 500. Did finish up 3.8%, but that stock has been under a lot of pressure for the last couple of months. And since we got the worst week in the markets for over a year last week, no real surprise to see your girl Janet Yellen out on the beat saying she sees no red lights flashing and the US economy is making a soft landing. That's despite the weakening job growth. She describes the current state as a soft landing, with inflation decreasing and wage growth surpassing inflation. She said the job growth is steady enough to absorb new labor market entrants, apparently saying America can accommodate the huge influx of migrants into the country of late. But she did mention the need to address the fiscal trajectory due to falling tax revenue and the upcoming burdens from Social Security and Medicare spending, advocating for manageable deficit level. Which is actually interesting that she says that, as she's been criticized for not really helping out the picture when it comes to United States debt, especially during COVID when yields dropped to rock bottom lows. She could have sold a lot of 10-year, 20-year, 30-year debt below 1%, basically lock in cheap capital for the United States, keep the interest expense low. Just like us as consumers, we want to lock in a low mortgage. United States should do that with their debt as well. However, what she's been doing is selling a lot of short-term debt, with a lot of people criticizing her of that, including Lawrence McDonald, New York Times bestselling author, who just said today, who will clean up this mess? By issuing nearly $2 trillion of T-bills, Janet Yellen succeeded in suppressing bond volatility in an election year. Now this paper has to be rolled over at much higher yields. The USA is like a financially trapped emerging market country living on the front end of the yield curve, a very dangerous game. And we can see how front-loaded United States debt maturity profile is. With another person, Michael Kao, former Goldman Sachs partner, saying, in my honest opinion, Janet Yellen will go down in history as one of the most negligent and blatantly political Treasury secretaries we've ever had. However, as much as Janet Yellen's always going to talk up her own book, is never going to induce fear into the economy and markets, she still could be right. There is still the possibility of a continued soft landing, at least for a little while longer. Since the inverted bond yield curve lasted about 540 days, maybe the time between when it uninverts and goes into a recession could also be a record. And there's also the possibility we could go back into inverted territory, and that could drag on for months longer as well. We've also got Apollo chief economist saying the US economy is not facing a recession, cites strong employment data, wage growth, and consumer spending as key indicators. GDP growth is projected at 2.1% for Q3, and corporate profits are at record highs. We've also got Tom Lee saying even though the market's facing a tough 8 weeks ahead, after we get past the election, we could see a 10% rally into year end. Potential for us to see a bottom this month or potentially next month, as he too thinks the economy is poised to avoid a recession. And it's true, high yield bonds are not suggesting a recession anytime soon either. They're actually breaking out, saying there's been a bit of a broadening in the breadth, which has happened over the last couple of months, although small caps have been weak of late. And Nvidia's sell-off isn't unique, saying that it might not be an omen for the market that some investors think. With them also saying we may have already seen the election year low. However, we've got some other research coming out from Bank of America saying there's a major flaw in the stock market's most bullish thesis, and that is that money market funds won't save the stock market from a painful decline. With them going on to say a 25 basis point Fed rate cut won't change the behavior of savers, and that if cash does leave money market funds, it won't flow to stocks. So that is a big part of the bull thesis. About $6 trillion sitting in money market funds, with the theory being when the Fed starts cutting interest rates, a lot of that money that had been earning 5% in money market funds will look for a new home, potentially in the stock market. However, Bank of America is arguing for that to happen, the Fed would need to cut rates by at least 3%, and that's not scheduled to happen anytime soon. Coming out from a different research analyst at Bank of America is them also saying don't buy the tech dip, and this is where you should invest instead as the market gets more volatile. They said to look for more high quality names as well as dividend-paying utility and real estate stocks. And that's true. That's definitely what the market's been doing the last couple of months. Big defensive rotation out of discretionary semiconductors, AI-related stocks, and into the more defensive yielding stocks like utilities and REITs. Two of the top three best performing sectors of late, including financial. They've also got data out showing the yield curve suggests higher VIX for years. We do see a bit of a correlation between the yield curve and the level of volatility in the market. We're then pointing out that quality, stability, and income have protected investors in prior volatile market, saying investors should avoid boosting exposure to the popular tech sector, citing record highs in valuation and that tech funds could soon face passive selling pressure as the S&P 500 prepares new index cap rules. The index is planning to lower the weightings of stock funds worth $350 billion in assets. And that's something I'm doing myself as well, positioning a bit more defensively. However, I'm not taking my whole portfolio into a defensive position. And anyone who's gone completely cash or completely defensive, short-term bonds or whatever, that's your portfolio pretty much implying and you pretty much saying, I 100% expect a recession. And so if that doesn't happen, there could be a big rotation back into growth stocks. And it's possible to miss out on that as money comes out of the defensives. The fact is nobody knows for sure what's going to happen, and that should be reflected in our positioning as well. I myself give the chances of a recession happening in the US in the next 6 to 12 months, somewhere between 50 and 60%, but of course that's changing from month to month. Just right here and now, it doesn't look imminent, but the risks have certainly risen on the back of a softening jobs labor market. And a lot of people are in this wait and see mode, calling it the great wait economy. As a lot of people are unsure about the future direction of the US economy, also the US dollar, what the political future might hold, just how bad's the jobs market going to get, what happens to the US economy if the amount of immigrants coming into their country, both legally and illegally, falls off a cliff. That may have actually been helping the US economy and GDP growth over the last couple of years. What happens if government spending gets cut a lot? What happens if it keeps going up a lot? There's still a lot up in the air, especially over the next couple of months. But something I show on my channel every now and then is this chart from Samuel Benner, Midwestern American farmer back in the 1800s. In fact, he made this chart in 1875. And it's basically a forecast of market cycles. It's been remarkably accurate ever since he made it 150 years ago. Down the bottom here in the C line, years of hard times, low prices, and a good time to buy stocks. Hold till the boom reaches the years of good times, then unload. With the last one being in 2023, prior to that 2012, 2005, 1996. Up here in the B line, years of good times, high prices, and the time to sell stocks. Previous being 2016, 2007 was a good time to sell, so was 1999. Apparently the next one is 2026, with the next good buying opportunity, 2032. Up the top in the A line, years in which panics have occurred and will occur again. Almost nailed it in 2019, just before COVID. 1999 was a market top. There was a recession back in the early 80s. 65 wasn't quite a top. 45 was the height of World War II. And 27 was off by about 2 years before the market peaked out in the Roaring 20. Next panicky forecast is in 2035. But interesting, the forecast time to sell stocks 2026, which very well could be the case. Like I said, this uninverted bond yield curve and it pointing to a recession could take over a year to materialize. So maybe stocks hold up. We do see S&P 500 6,000 or 6,500 before it does make a top in 26. Fact is, it's the top 20-30% wealthiest consumers pretty much holding up a lot of consumer discretionary spending. Bottom 2/3 really struggling. Many people working an extra job, extra part-time job, even 2 or 3 jobs, and still struggling to pay their rent and pay their food. And that's because while a lot of their wages have stagnated, the cost of living for them has gone up 30 or 40%, pretty much eaten all of their discretionary spend, thanks to record government spending, massively increasing the supply of currency in circulation, naturally inflating everything. And that really helps the rich, who are largely asset owners, with their personal spending, not really affecting their wealth at all. And one of the best visualizations of that over the last couple of years is a huge divergence in some retail stocks like Dollar General, now down at multi-year lows. And that's typically where low middle income consumers shop. On the other hand, where the 1% shops, Ferrari, currently sitting at all-time highs. The rich have never been richer, whilst the middle class have never struggled more. And we may not have seen the worst of it. Even though inflation is really high, a lot of people have good equity in their homes, especially over the last couple of years. In fact, a record amount of equity. However, in the States, just like we're seeing around the West, residential real estate may be rolling over a bit. We just saw median home prices falling 1.3% year over year in August, and for sale inventory hitting the highest level since May 2020. And just looking in the States, 10 US metro areas where prices are falling the fastest. Nashville, down 5.7%. Denver, down 6.1%. Tampa, down 6.2%. Cincinnati, down 6.7%. Oklahoma City, down 7.3%. Austin, Texas, down 7.6%. San Francisco, down 7.7%. Kansas City, down 8.5%. San Diego, down 9.1%, and surprisingly, the biggest year-over-year change down in Miami, 11.7%. Was a really hot market. A lot of companies relocated there. Leaving New York, just like we saw a lot of companies and people leaving California and relocating to Texas. But the fact is, doesn't matter what state it is, housing is expensive. Looking at the average home price to US median household income ratio, all-time record just below 8. A lot of the boomers, when they were young, they were paying 3.5 times, 4 times their household income to buy a house. A lot of millennials now, that ratio is blown out double, and that's especially accelerated since 2020. No coincidence. So is government spending and Fed liquidity. And so think about a lot of people still working, have a lot of equity in their homes. Now we've got a softening in the jobs market, definitely downtrending. The amount of growth and new jobs in the US economy. A lot of people lose their jobs. They may just look to put their house on the market and unlock that equity to tie them through a bad year or two, especially if they can't find work or their partner can't find work. And that may also cause a bit of selling in the stock market, not to mention valuations getting compressed. So in other words, over the next 6, 12, even 18 months, if the stock market and real estate market doesn't correct, we don't get a recession, that would kind of be the very best case outcome and scenario, and would go against a lot of indicators and valuations, which typically revert back to the mean, even though they can diverge for a long time. And the price action we're getting in short-term US bonds is a little worrying, really nosediving on the 2-year. In fact, I think we've got the biggest gap between the 2-year yield and the Fed fund futures. The bond market pretty much crying recession. Look at the 2-year down at 367 here, implying that the Fed is going to have to do a lot of cutting in the near future. And so the other big news event this week is inflation. CPI due out this Wednesday. However, next Wednesday, the Fed is meeting, in which they're pretty much guaranteed to start cutting interest rates. However, it's still up in the air whether they'll start off big or small. 25 basis points or 50 basis points. Looking back at the last 5 first Fed rate cuts after a hiking cycle, the last 2 times they started off with 0.5% back in September 07, back in January 01. Stock market went on to give us negative returns 1, 2, 3, and 4 years later. However, the other 3 times they started with 25 basis points, we were positive across the board. So there is a big difference. And because when the Fed goes big, that means they're worried and responding to something that they see out there in the economy. So it could very well have big implications. Just how big J. Powell goes come next Wednesday. Moving on to commodities, we've got tropical storm building in the Gulf of Mexico. Francine, which could be threatening operations there come midweek. National Weather Service issued a hurricane watch for the Louisiana coast due to tropical storm Francine. All futures moving higher. Gas and heating oil getting a bit of a bump up. We've also got news that China's been adding to its strategic oil reserves as well. And we've had key operators in the region, Shell and ExxonMobil, shut down and evacuated personnel at various Gulf of Mexico assets due to the storm. But at this stage, it shouldn't be a large-scale event. And once again, the crude oil market doesn't seem worried at all. Still struggling to find support here at the bottom of this big zone, $68, $75 a barrel. And just an interesting graphic I thought I'd share with you guys today. Just looking at a barrel of crude oil, which is 42 gallons, produces just under 45 gallons of refined products, from transportation fuels to essential materials for everyday products. And this graphic kind of shows you where a barrel of oil goes. 42.7% to gas, 27.4% to diesel, 5.8% to jet fuel, 5% to heavy fuel, 4% to asphalt, 3% to light fuels, 2% to hydrocarbons, and 10% to other things to make products like tires, petrochemicals, and other miscellaneous products. Most people don't realize how much oil goes into everyday items and products we use in the home and office, and that's why it's still going to be around for many, many more years. But as a whole, apart from gold and a couple of others just holding up, most commodities for the here and now are weak, as we're still seeing softness in the world's biggest consumer of them, China. And they're the biggest importers and users of steel, with Xi Jinping famously warning the world anybody looking to invade China will face the Great Wall of Steel. However, we've got iron ore futures breaking out to new 52-week lows, which is the key component used to make steel. Just moving on to crypto, we've got Bitcoin trading heavy of late, seeing investors pulling back. Net outflows for 8 consecutive days in Bitcoin ETFs, totaling 1.2 billion. That's the longest stretch since they debuted in January. Seen a bit of a risk-off move. That's been happening in the AI chip stocks, also correlating with Bitcoin, along with that defensive rotation. Bit of risk coming out of markets. And that too, like a few other markets, just trading down near support. Did bounce a bit here today, $57,000 a coin. But Bitcoin has a big swing factor built into its price now, whether this guy's going to win the election or not. With some saying if he does, it could soar 59% to $90,000 a coin. I wouldn't be surprised to see it hit $100,000 by Christmas, especially if we get a bit of a risk-on move across markets, which could very well happen. With the potential new president arguing he wants to make the US the crypto capital of the planet, wants to get well out in front of China on the issue, who's pretty much turned the other way, kicked out all their Bitcoin miners, as they like having complete control over their currency, in which they fix it to other currencies. They don't even allow it to float, trade in a free market. So this election's having big knock-on effects to a lot of markets already. We saw that again today with cannabis stocks rallying up after Trump supports moving the drug to a less restrictive category. Said he would also support new banking rules, more research to unlock the medical uses, and that the country needs to end needless arrests and incarcerations of adults for small amounts of marijuana. Actually went on to say he'll be voting yes on Amendment 3 this November. It's the state of Florida, allowing citizens to vote on the topic. And so since the current administration wasn't able to get this done as promised, he looks to be seizing upon this opportunity to try and get it done and move the industry forward. And so once again, us investors hang on to hope that some politician will eventually do the right thing. And that's why we got a good bump up in the beaten down cannabis ETF today, MSOS, trading up 11.3% on pretty good volume here. And like I said last week, I thought it was a good level and contrarian play as the potential new administration could very well actually get it done as promised, and off these beaten levels and valuations, it once again set up for a good risk reward. But as usual, it's going to be a very volatile and bumpy road, as the new admin will still have to get past Big Pharma, who have been throwing up every roadblock possible for years now, as this natural plant threatens their pain management business, amongst others. Remember, the way the system's currently set up, it achieves exactly what it's designed for: maximum shareholder profit, not maximum health outcomes for you and me. And it'll be interesting to see if markets respond like they did after the last debate. Between the current sitting president and his opponent, we definitely got some big moves coming out of that. Now we'll see the replaced contender against her opponent debate each other tomorrow night in Philadelphia, in which it'll certainly be interesting to see how that goes, as she's only done one scheduled interview since she was nominated, with CNN and her VP by her side, whereas her opponent pretty much does one every day unscripted, and she may face some criticism about what's happened over the last couple of months. With one journalist today, Glenn Greenwald, saying the US has no functional president and has not had one for months, and it's barely noticeable and barely matters because there's a permanent, unelected machine that runs the government. And it's kind of crazy, isn't it? Does anyone remember 2 months ago, this guy here saying, I'm not going anywhere, and that only the Lord Almighty could drive him from the race? Once again, that was only 2 months ago, back in early July. Then he pulled out, didn't really give us a reason why, and it's not really apparent who exactly is running the states right at this moment. And it's interesting because we're seeing a lot of really influential outsiders really start to speak out on this. Not only billionaire hedge fund managers, also one of the world's largest asset managers, CEO of Blackstone, Elon Musk, which the current admin sees as a huge threat now that he owns one of the biggest social media networks on the internet and is encouraging free speech, says the new puppet is the same as the old puppet. And a lot of people are hoping more outsiders enter politics, try and do what's right, not only for America, but for a lot of Western countries, which seem to be going in a different direction. And what's interesting, if you look at overall inflation in the last 24 years, everything's up 74%. But what's really up a lot, but what's different about what's up a lot here in the red lines? Housing, food, childcare, medical services, education, hospitals, and down here in the blue, cars, households, clothing, cell phones, software, toys, TVs. The biggest difference between these two lines, as these are more free markets and these are more government intervention. Whenever the government gets too involved in something, whether over-regulation, over-taxation, or even trying to do it all themselves, they end up creating a lot of inefficiencies, and that shows up in price increases. And that's why the potential new president is going to give Elon Musk a job in which he could be the head of the Department of Government Efficiency, overlooking government spending, making sure the government is accountable on every dollar of taxpayer money, as hundreds of billions a year are wasted in fraud. More money is sent overseas to defend foreign borders than their own border. And a lot of people kind of disconnect from government spending and the federal debt. They don't really understand it. They don't see how it really relates to themselves. However, can you imagine if everybody got a receipt at the end of their career that showed exactly where your tax dollars were spent? That might make some people feel different if they could actually make a real connection between the output of their labor and where their money was actually spent. And I think this is a trend that could grow a lot around the West, when we're seeing more and more outsiders enter the political ring as they don't like what they're seeing in their countries. We just heard that over the weekend with famous MMA fighter Conor McGregor saying he might run for president. And of course, mainstream media don't like it when political outsiders enter the race. They like to toe the line. However, I think this is a trend that's going to continue and continue. We even heard others like Mr. Beast said he'd like to run for US president one day. As a lot of people are fed up with the establishment, and I guess a lot of people don't like working two jobs just to struggle at the end of the day as well. And we'll just finish out the data and research today with an interesting chart. Average annual hours work, looking at developed economies, all the way back to 1970 to where we are today. Currently up the top in the dark green line, United States. As I regularly point out, Americans work a lot harder than other developed economies. Didn't always used to be the case. It was actually the Japanese working the hardest in the 70s and the 80s. They're still number 2, but Europeans, on average, working 1,500 or less hours a year compared to Americans, which work about 1,800 hours. And that didn't always used to be the case. If you look back here in the 70s, it was kind of all similar. And this could be a part of the reason why capital markets in America have just exploded away from European markets in this time. America's productivity is just so much higher, and they also lead technology. And just looking out to the economic calendar, inflation rate month over month 0.2%, year over year expected to come in at 2.6% this Wednesday. That's the big data print we'll be looking to this week, and what sort of reaction we get in bond yields, and of course the stock market, which is still on soft ground. Volatility index at 19 and volatility risk premium still positive here, and the market definitely choking up a little bit, which may just continue coiling up until we get CPI on Wednesday. Then we'll see whether we can stop the slide that started last week. Other than that, that's all I've got for you today. Thanks very much for tuning in, and I'll see you again tomorrow night. Cheers.